Hey everyone. Hope everyone had a good day. Let me just check some of the lines here. So the daily chart, you can see we had a low one short below yesterday's low, and we broke to the downside today. And the sell-off over the past, these three big bear bars, the sell-off that ended last Friday on the 20th, you can see the market started to go sideways right at the October the 6th low. And my one thought here was we were going to go sideways, and I still think we're going to go sideways. The bears, they're trying to get a second leg down and test the midpoint of this rally, the rally that began on October, back in October of 2022, right here. Here is the beginning of the rally all the way up to July 27th, of this year. And the midpoint is this red line. And you can see we're really, really close to it. And it wouldn't surprise me one bit if we get down to this area. And that is basically 41.72. Low one short, bad sell signal below, and the bulls likely bought it. So if bulls bought the low one, which is yesterday's low, and now this bar is closing down here, the question is, how desperate are the bulls in getting out? I don't think the bulls are going to sell out longs and just panic. So that means tomorrow, I think tomorrow is going to test the low one and probably allow a lot of those limit order bulls out, the bulls that bought yesterday's low and more lower. And I suspect a lot of those bulls would buy yesterday's low and more below last Monday, this past Monday. So on the daily chart, we're probably going to be sideways. The bulls are disappointed. They bought this rally and they got trapped on the sell-off, and they're deciding what to do. If chances are, or the odds are, there's sellers somewhere around here, 4,300, the high of this area right here. The reality is there's probably sellers in this area. Now, the one thing that could change that is if the bulls start to get a double bottom. So if the bulls get a second entry buy, and let's say tomorrow's a bull bar closing on its high, a big bull bar, and then the next day, Friday, another big bull bar closing on its high, you may have bulls begin to question. They may think, maybe instead of stalling here, we're going to go all the way up to here. So the bulls are deciding, depending on how the rally forms, will dictate how many traders begin to exit. If the rally starts to go up with a lot of tails and starts to hesitate in this area, it'll be close to 50-50 if we get a second leg down or go up here. Right now, I think we're going a little bit lower. What are the chances that we get a big bear breakout? Here's the weekly chart. So what are the chances that we collapse all the way down to 4,000? Right now, I think the odds are pretty low. More likely, we're going to go sideways before we do that. Channel down's tight, and the reality is we could easily go all the way up here, go sideways, and then get a second leg down. Just look at this chart for a moment. What do you see here? You know this is obviously, I'm going to get rid of all these lines. I'll redraw them later. But you know this whole area is in a large trading range. And if it's in a trading range, we could easily collapse all the way down to the 2022 low. And I suspect we probably will get down there. Why? Let's look at the monthly chart. If you buy right here and the market goes all the way up here, are you expecting a bull trend or a trading range? You're obviously expecting a trading range. Trading ranges are really forgiving. You sell down here, you scale in, you buy up here, scale in lower, you exit here. Even the bears that sold, there was some unfortunate bear who made the mistake, obviously, of selling right there, this red line. They sold this close, scaled in higher. Chances are they will make money if this is a trading range. And ultimately, I think we will. I think we will fall below the low of this bar. This is the October 2022 low. The question is, are we going to have? It'll probably take several bars, which means it could take easily a year or more. We may rally to a new high of the day, but with three big bear bars, chances are this is not the start of a strong channel. This is the start of a trading range, and there's probably sellers above, and there's probably buyers below scaling in lower. The buyers, they may come in right here at the low of March. They might be right here. They're testing a breakout point. We're under the breakout point, and we're below this big bull bar June 30th. With the size of last month in this bar, I suspect we'll go a little bit lower, but it's a little bit tricky as far as the bulls buying here. They're obviously institutional bulls, and they'll happily buy more at the 2022 low. I think the mistake, I think a mistake for traders would be to buy here and stop themselves out here. I think the reality is the bulls buying here, they're dollar cost averaging in, they're scaling in, and they'll see this as it's been a bull trend for so many years. They'll scale in all the way down, betting on a trading range. Give me just one quick moment. Thank you for your patience. So back to where we were. Monthly chart, we're going to be sideways for a long, long time. And the point with me bringing that up is chances are we'll probably pause somewhere in this area. Low probability we collapse. We're probably near the bottom of a channel. At this there were buyers at this breakout point, August the 18th. There's probably buyers at this breakout point right here, October the 6th. So I think the market's going to have a hard time getting far away. Let's go to the 5-minute chart. First thing I do on any day, if I have zero lines drawn, first thing I'm always going to do, there's three things, but there's really two right from the beginning. I'm going to plot or draw yesterday's high and yesterday's low because the market usually will either go above yesterday's high or go above yesterday's low. And obviously, when I say yesterday's high or yesterday's low, I'm referring to the prior trading day. So if it's Monday and I say yesterday, I'm referring to Friday. So first bar of the day, let's get this where we can see it better. There we go. First bar of the day, bar one, big bear bar following a gap down. So the market is accepting the gap down, and that's good for the market's accepting the gap down, and that's good for the bears. But If you read the blog, if you read the daily blogs, if you've listened to Al's video course, if you've heard me say this many times. Bar one typically will not be the high or the low of the day. And there's an 80% chance that you're going to get a trading range open. There's only a 20% chance you're going to get a trend from the open. Obviously, 20% chance on the open. If bar one closes on its low, bar two closes on its low, bar three closes on its low, that changes the probabilities. But right now, chances are the market's going to wants to get below the low of. I just realized something. I'm going to stop sharing because you cannot see the pointer. There we go. Chances are the market's going to fall below bar 42, the low of yesterday. Bar two, bear bar closing above its midpoint. Low probability. Bear bar closing on above its midpoint, but two consecutive bear bars, probably sellers above. Is it sell to close on bar two, betting on lower prices? I don't know. It's a pullback from the gap down, bar one and two. So bar two pulled back. But chances are traders will sell the first pullback. So we'll probably fall below bar two. But there's probably buyers not far below two and below yesterday's 41. And then three, a little bit of a surprise, three consecutive bear bars, always in short. Because you have a breakout, reasonable to assume that the market may try and get a measured move down. There's actually one thing really interesting I just noticed, and I want to see something here. The open of the day is actually the high tick of the day. So I'm going to look up really quick. I want to look up the CME, what the high of the day was in the open. I want to see if the CME is showing the same thing. So whenever you have a discrepancy on price, always go to the CME website. So here's the December contract. We're going to click on this chart. We're going to pull it up. And let's go to 5-minute chart. This is actually in Central Time. So we can, a lot of times I have this computer in Eastern Time. By the way, I mentioned I had computer troubles yesterday. For whatever reason, TradeStation would just not work. And I reinstalled it. I uninstalled it, reinstalled it 2 or 3 times, and it could not keep up with any market, even with just one chart open. And it's a really good computer, so I couldn't figure out why. But I completely wiped the computer, factory reset it, and it fixed it. So that's why this computer is now in Central Time. I just realized that. Here is bar one, 8:30, and you can see the high is actually 53.5, and the open is 53.5. And what's really interesting about that is what's really interesting about that is how many times do you see a day where the open is the exact high of the day? It's very rare. It's actually really rare. And because of that, typically there's greater than a 90% chance. Maybe it's 95% chance. But the point is, there's not many days where the opening tick is the extreme of the day. So that's worth noting. And how do you make money with that? I don't know. You can bet that the move's going to reverse, but the reality is, are you going to buy bar one or bar two, betting you're going to get to the open before and put a stop down here? Probably not. As Al would say, it's one of those really interesting things to know that most of the time the open has at least a 1 or 2 tick tail at a minimum, and usually the open is not the extreme. I'm going to make a note on that just really quick. Okay, I'm back. So where were we? Bar one, big bear bar closing on its low. Bar two, follow through, maybe always in short, but probably sellers above. And then bar three. Three is another big bear bar. Three consecutive bear bars probably going to go down for a measured move, far from the moving average. So we may stall for at least a couple of bars, but traders will sell, use a wide stop, betting on a second leg down. And then bar four, another bear bar. So obviously, this is a surprise, and surprises usually get second legs. And this is probably a big enough surprise to be the dominant feature of the day. Now, what's the difference between this open right here and the one we had a couple of days ago? Let me find it. So these three bars versus these three bars right here. What's the difference? Why did this sell off and go a long way and today not do that? One was context. Here, where obviously we've been in a bear trend for a while. And if I just zoom out, look at this. This is why it can help you to understand higher time frame context. We've been in a bear trend for several days, and we've been channeling down for a lot of days. Bear channel, trading range, breakout, second leg down. It's a large lower low major trend reversal and probably a final flag with this price action here. Right here, it's a little bit different. This is a breakout of a relatively tight trading range on the daily chart. We can see it right here. I'm actually wrong. This is the tight trading range of pretty much yesterday. But we had a tight trading range with yesterday and also the prior day. And you can see we broke far below all those price levels during the morning. So here's that. Basically, here's the low. We broke below it, obviously retraced it, but got a second leg. I want to see one more thing. Because we had a gap down, I doubt we did this. Obviously, that's too far. Anyways, the point is three big bear bars when the context makes a lot of sense to get a second leg. That's good for the bears. Here, because it was a bear breakout, even if we retest these breakout points, the odds were we were going to have a trading range and not a sharp opposite trend. So the odds were less likely that we would get a measured move up in the opposite direction. Doji bar on five, so some sell the close traders. They will be disappointed and they will look to exit at the close of bar four. And then six, bull bar closing on its high, testing the high of four. Some traders, they'll sell above five, they'll sell the close of six. And on a smaller time frame, it's a two-legged pullback. Even though it's the first pullback on this time frame, the market rallied on bar five, sold off on five, rallied on six. So if seven sells off, it's a second entry short. And that's exactly why seven sold off the way it did. And then bar seven, tail below the bar, probably buyers not far below, and probably evolving into a channel. But the second leg is probably going to be bigger than this. Bull bar on eight. For the bulls, some bulls bought below six and more lower, and they'll use the bounce on eight to sell out of longs. And that's in part why nine went down. Seven was a big enough surprise. Nine is the second leg down. Probably buyers below eight, just like there were buyers below seven. So bears and bulls are buying below bars and selling above bars. So we had a bear breakout on seven, tight trading range for these three bars. The market's deciding, is this a flag? Is it going to get trend resumption down or trend reversal up? Another inside bar on 10, and then a bull bar on 11. We're getting enough of a bottom. We'll probably bounce and test the close of bar six, but we could easily get one more push down. Right now, we have one clear push down to bar four or five, second leg down to bar nine. We'll probably get a third leg down. Even if we do, it's probably minor. It's parabolic at best. One, two, three, and it's not that broad on a higher time frame. This channel is a series of breakout bars, maybe on a 15-minute chart. So 15-minute chart right here, big bear bar, bad follow through, second leg down. 13, bull bar, but overlapping most of the prior 5 or 6 bars, so not a great buy. 14, a big bull bar, surprise. You can see it's testing the breakout point, the 42 low. What about buying the close of 14, betting on a reversal up? I would not. Look what the market did. The market rallied up to 13, sold off to the 14 low, rallied here, and sold off into the close. That means traders are selling into the close and taking profits into the close. And it's better if traders look to it's better for traders if they look to enter on a pullback. Strong enough trend line break, we are probably going to go sideways. And if we do go down, there's probably buyers not far below. Bull bar on 15. Make the bars a little bit bigger here. So bull bar 15, inside bar, probably buyers below. You're right in the middle of the pullback, 50% pullback, the high of this bar, low of this bar. 50% is going to be right in this area. Plus, think about all those bulls who bought the low of 41 during this breakout. They bought the low here, they scaled in. What do you think they're going to do in this price area? You know, a lot of those traders are going to sell, or they'll look to sell after a second leg. So a lot of the traders who bought on the way up, disappointed with 15, they might hold for a brief second leg, but if the market goes sideways, they'll be pretty quick to get out. 16, another bull bar, but we have a bull bar on 11, bear bar 12, bull bars with tails 14, 13, and 14, and then a bear bar 15, bull bar 16. Chances are 17 is going to disappoint the bulls. And then you can see 17 obviously pulled back. So 17, bear bar closing on its low. Some traders probably will sell below it. Parabolic wedge right here. So it's an okay sell, but it's a tight bull channel, and the first reversal down probably will be minor. But the bear selling here, they're taking a chance that the bulls get trapped. So they want something like, let's see what we can find an example. Something like this. It's not really a great example, or this is a better example. Tight bull channel up to 52, and then 2 big bear bars, really three bear bars down to 55. That trapped bulls who are hoping for a second leg. So bulls buying here are hoping for a second leg up. And what would trap them is a strong follow through bar. It's kind of like the euro dollar. We had this big bull bar here, and then we had this sudden big bear bar. And you know what I'm going to say. If you bought the close of this bar hoping for a breakout, you can see it on the 60-minute chart. Here's the breakout. You bought it, but then the market formed a parabolic wedge, and then this was your reversal attempt. It's so strong, it trapped traders, and now it's leading to a couple of legs down. So, anyways, the point I'm making is if we get a big bear bar, we could easily get a decent breakout below bar 12. Chances are we will not get that. And then 18, what do you think happened on 18? 18 is bad follow through for the Bears. The Bears who sold below 17, taking a chance that the market was going to plunge down. 18 was not the bar they were looking for. And then 19, as soon as 18 closed, those traders just hit buy the market. They were so disappointed on their follow through that they were happy to exit the trade even with a small loss. And the bulls, a lot of bulls just said screw it, and they bought, taking a chance we would rally for a second leg up. 19 bull bar, but a tail above the bar. And what do you notice? We have a breakout on 14. I'm going to remove this. Breakout on 14 here. Pause. Another breakout on 16. Pause. And then another breakout. So it's another wedge, and it's basically an expanding triangle. One, pause, two, or one, push up, push down, a move up, a move down, a move up, chances are we're going to pull back to the middle of this range. Expanding triangles are the reversal attempts, and more often than not, especially in a strong trend, expanding triangles, which are variants of tight trading ranges on higher time frames, an expanding triangle leads to trend continuation more. For whatever, for whatever reason, allergies have gotten to me way more this year than any other year. Anyways, we have an expanding triangle right here. Typically, expanding triangles in trends lead to trend resumption. That's why Al says tight trading ranges, which is the same as an expanding triangle. It's a variant of a tight trading range on a higher time frame. Typically leads to trend resumption. However, when you get a tight trading range near resistance, especially in an overall trading range day with a lot of attempts up, you can easily get a reversal down. And then you can see 20 bear bar, but a small body. What about selling below 20? Some traders might, other traders would rather wait and see what the follow through looks like. But this is not what you want to see if you're a bull. And traders are beginning to wonder, what if this is the lower high right here? And if it is, that means we might be in a channel and we can go all the way down here. 21, buyers below 20, they see 19 as being strong enough for a second leg. But now 21's a breakout pullback buy setup after 19, and there's probably sellers above it. In 22, it triggered the buy and pulled back just enough for traders to try and scalp out for a profit. Some bulls, bears would do that. They sell above and they scalp out in the middle. In the bulls, they look to buy in the midpoint, hoping for higher prices. And instead, you can see 23 was a surprise bear breakout. 23, big enough bar, probably going to go at least a little bit lower. But the one thing I want to draw attention to is this. I'm going to start removing some lines so that we can have a cleaner chart. When I see this, the one thing I want to think about is this right here. Big bear bar, but big bear bar within what? Big bear bar within an overall trading range. I'm going to change my line really quick. It's good enough. Let me just save the defaults. Tight trading range. So when you see a big bear bar, it's a possible sell vacuum test at the bottom of the range, which means there could be buyers below for a second leg. And that's why 24 reversed up. Whenever you see these big bars, it's really common for the market to stall for the first minute and then all those traders who sold the close to give up and the market reverses. It's the same thing as selling below 17. If you sell below 17 and then you get this kind of follow through, it takes 5 minutes for that follow through to show up. Therefore, if you do take that trade, think about it. What's going to happen if you get bad follow through? You have 5 minutes to exit the trade. So I want to see if you sold the close of 1020, the close was 40, your entry price is 45 and a half. Excuse me, it's actually 40, it's 37 and a half. And that is 1020 to 1025 Central Time. So let's go to that. So it's 37 and a half. So here is the close of that first 5 minute bar right here. And it looks really small but when you think about it, this bar closed, which is this bar, and then on the open of this bar, the market sold off. So if you can, pay attention to this chart right here and ignore the fact it's a 1 minute chart. You sell the close of this bar, it's a bear breakout closing on its low, sell the close. And then you get another bear breakout, but it's also looks somewhat like a bear channel. It's a bear breakout with a big tail. That is the entry bar. That's the first minute of this bar, the sell off. And then look at this bar, reversal. So a lot of traders, they see what happened. The market tested the lows right here. And as it sold off and tested these lows, the market started to reverse up. So a lot of those traders said, you know, they in essence bailed out of the trade because they concluded it was a sell vacuum. It was not momentum bears selling aggressively. There were bears selling up here, betting one a sell vacuum, but it was not this. It was not bears selling and continuing to sell. And that happens a lot. You get a big bar, hesitation for a minute on the next bar, and then a reversal. That's what happened with a lot of these bars in here. So bear bar closing on its low, but bulls obviously buying below bars and buying breakout points, expecting deep pullbacks. And then 24 reversed up. What about buying above 24? Some traders might, but do you really want to buy? Buying above 24 is the same problem as selling down here. You're buying at the high of the trading range, and you can see what happened on 25. There were more sellers above the high than buyers, and the bulls could not trigger the buy. 25, bear bar closing on its low. It's an inside bar, so some traders will call it a triangle here and here. But tight trading ranges are generally meaningless in the middle of larger tight trading ranges. It's a 50-50 market, and it's really better to do nothing. 26, bull bar, but a tail. So some traders, they see 24 as a breakout. They see 25 as a pullback. They buy here, and now they're deciding what to do. As far as 26, I think it's a low probability buy. Most traders are better off waiting for the breakout. 27, bear bar, second leg down from either 25 or the sell off on 23 and the 24 low. But 27 is also a failed breakout of the trading range, bar 18 and 24. But it's a bear bar closing above its midpoint, so it's a bad stop entry buy above. For the bears, it's a micro channel since bar 22, so it's about a 5 bar micro channel. That lowers the probability of buying above, plus you're relatively high in the range. And this sell off was strong enough. This might be a sell leg one, pullback, leg two. We triggered the buy above 27 on 28, reverse down. What about buying below 28? Some traders might. Taking a chance. It's a bad low one below 28, but it's in the middle of the range, and we could easily vacuum all the way down here. So if you're buying below 28, it's not the world's greatest buy with it being in the middle of the range. Plus, the bulls have tried several times to reverse, and it looks like they might be failing. And then you get 29. 29 is a terrible, it's not a great bull bar, and the channel down is getting tighter. So some bulls, if they bought the low of 28, which is not terrible, if they did buy the low of 28 and then they see 29, they might start to get a little bit concerned about their trade. They bought the low of 28 because they were worried that the market might reverse up quickly, and it didn't reverse up. Instead, it went lower. That means that their premise, they have to question if their premise is still valid. And then look what happened on 30. So you buy the low of 28 here at 34 even, and then the market goes all the way down to 30.25. So what does that tell you? The market went 3.75 points below the low of this bar. If you sold below this bar, your entry price is 33.75. You need the market to go to, let's see here. It needed to go to 30 and a half in order to get 3 points. So the bears who sold, they were able to make 3 points. But more importantly, the bulls that bought the low of 28 here at 34 even, look at the high 2 bars later on 30. The high of the bar is 34 and a half. What that means is bulls who bought this low, disappointed with this bar, they were able to get out break even back at the low of 28 during 30. 30, bear bar closing on its low, probably going to go a little bit lower, but we're breaking out below a tight trading range in an overall trading range day. I suspect that these bears selling will be disappointed soon and the market will go sideways. Doji 32, but a lot of overlap with the prior bar, near support, the 12 low. Probably buyers not far below, but some traders will sell, taking a chance we break strongly to the downside. 34 inside bar, tight bear channel, but a lot of overlap, so the market's channeling down. Although the first reversal up will probably fail, chances are the market's going to get a deep pullback, so it's probably going to test one of these breakout points. So a lot of traders, instead of selling here, they'd rather wait and sell a pullback. 35 bull bar closing above its midpoint, good for the bulls, probably strong enough for a second leg. 36 a pullback, low one short, probably buyers below for the second leg. And you can see what happened on 37. 37 closed the gap. So the bulls who bought the 27 low, the 29 low, and more lower, they're making money. However, what about buying the close of 37? I would not. Tight bear channel, and the odds are the market's going to go more sideways than straight up. And that's why 39 looks the way it does. 39 second entry short. You can also argue a wedge with 33, 37, and 38, and then a bear bar at 39. We might break to the downside. I suspect we'll probably try and get a new low and a third leg down, 12.33, and somewhere down here. Plus, we have the trend line just below, and that's what 39 was testing here. 39, what about selling the close or buying the close? This is a buy zone, so it's probably better to buy than to sell. But the sell off was strong enough, we'll probably get at least a small second leg. The bulls who bought the 37 low or the 38 low and more lower are probably disappointed. And that could easily lead to a sell off. And the bears, some unfortunate bear sold the low of 36, and the chances are they're willing to scale in. And because of that, we'll probably get this, and that is testing the low of the day. Low one shorts are always testing an extreme. High one buys are always testing an extreme. We had a big bull bar. We had a rally. Let's use this bar right here, bar 8. We had a sell off and then a 2-bar pullback. If we sell off and test the low of bar 6, it's a low 1. Even if we trigger the bar 6 low and we fall below it on 7, it's a low 1 sell. Low ones are always testing the extreme of the move. And that's why a lot of them find buyers. So there's usually buyers below low ones. There's usually sellers above high ones, kind of like right here. The bulls that bought up here and then they see 21. Guess what? There were more sellers above. So let's see, 40 probably going a little bit lower, but there's probably buyers not far below. And I suspect there will be bulls buying the low of 9 or a couple of points below. You can see it dipped below 9 and traders bought. So the bulls made money. And the chances are there's buyers below 33 or even the 39 low. 40 doji, probably going to go sideways to up. Tight bear channel down. That'll limit the upside, but I suspect there are buyers below and sellers maybe around the midpoint of the low one on 40. 42 doji, outside bar, trading range bar, probably going to go more sideways. And then you can see what happened on 43. We tested this breakout point right here, and we went one tick above it and reversed down. And that's a sign of disappointed bears. What about selling the close of 43? Betting on a breakout. It's an outside bar and it's breaking out below a wedge, 33, 39, and 42. And you can also argue it's a complex wedge or nested. I say that it's a wedge bottom at the bottom of a channel. So that's good for the bulls. But the channel down is fairly tight. And even if we go a little, there's a few targets below. We've got the measured move of the opening bars from here to here. So that's not far. And we'll probably try and get there. But outside bars are trading range bars, and they typically lead to pullbacks. Outside bar 43, trading range bar. That's why traders bought it. 44, a bull bar. You can argue it's a failed breakout below a channel. The bottom of the channel, 33, 39, and then the breakout below the channel being 43. But the channel is so tight, bulls are not making money. Chances are the market's going to go more sideways. And then 45 consecutive bull bars. Good for the bulls, but the bulls really need an upside breakout. And then you can see we went sideways for a couple of bars. The bulls who bought above 44, disappointed 45, 46, 47. They got out as the market reversed down. 48, 49, a little bit of a surprise. We may go a little bit lower. You can see there's a possible gap right here. And therefore, the traders want a measured move down. Maybe the first target is the gap from here, but that's been not right there. That might be the first target, a gap from the high of here to the low of here. Seeing that as leg one, which would project all the way down there. But you can see we're right at the measured move target from the open of 1, close of 4. So chances are we'll find some buyers. Now, as far as buying 49, some traders will, but I suspect you need a pretty wide stop. The reality is, because of that measuring gap, we could easily get a measured move of this entire range all the way down. 50, bear inside bar, probably buyers. It's 3 consecutive bear bars, but it's the best looking sell-off ever since bar 20 today. And chances are it's probably exhaustive and going to lead to more sideways trading. 51, a doji. Hesitation increases the probability that the market's going to go more sideways. You can see bulls bought the 33 low and more lower, and they were able to get out around the break-even price. They buy the 39 low and more lower, able to get out above the break-even price. And some traders will see this as a bear breakout below a wedge, and therefore they will expect 2 legs down. But I suspect we're going to test the breakout point of the 43 low right here. 52, bear bar, and then a reversal up. Why did that happen? Because we had a breakout, 48, 49, and 49 had a tail, and then 50 rallied, and then 51 had a lot of overlap, and then 52 closed on its low. It's channeling down, and 52 is trying to get a bear breakout below the channel on a smaller time frame. So let's draw it like this. Here's 1245 to 1250. Here is that channel I was talking about. Look right there. 1, 2. There's the breakout below the channel. We had a spike, pullback for a couple of bars, 5 or 6, 7 minutes, sideways. There's the second leg, and then a third leg down, and then it reversed up. So that's in part why the market reversed here. 53, bull bar, closing on its high. Probably buyers not far below, and we're probably going to go sideways and test the breakout point soon. But just like there were sellers at all of these breakout points, there might be sellers at this breakout point. 54, bulls, bears giving up, and bulls buying aggressively. But the channel down, the sell-off to 52 is a fairly tight channel, and it's a strong breakout. Therefore, there's probably sellers somewhere above, maybe near the breakout point. There might be sellers after the bulls get 2 legs up, with 54 being the first leg. And then we had a pause on 55. And then 56 is a high one, and traders obviously bought below it, and we got a second leg up. What about buying the close of 57? Some traders might. My only problem here is it's a trend line break. We've been in a bear channel. That's good for the bears. We're breaking above the channel. That's good for the bulls. But typically channels evolve into trading ranges, especially when they get broken out. So we have leg 1, pause, leg 2. We're closing above the breakout point. That means this whole thing is probably exhaustion, but exhaustion can lead to sideways trading for a while. 57, because it's an outside bar, that reduces the probability of buying the close. And then 58 is a doji. It's not a great sell the close bar, and it's a warning that 57 will probably get a second leg, but it's also warning traders that the second leg will probably be disappointing, and traders will see it as a wedge. First push 55, second 50, 58, and then third somewhere up here. And you can see the bulls got a second leg up on 59. 60, breakout below 59, 58. 60 might be a strong enough surprise. We'll probably test 57, the minor higher low. And then 61, we tried to test, we tested the low of 59 and then pulled back. So completely overlapping 60. That's a warning that we're probably not going to go much lower. 62, followed through bar, but a weak follow through bar, testing support. And 63, trying to break out, but you're in a trading range. There were bears who sold all the way down here. And the reality is those bears scaled in. And now we're testing the lows. And you know those bears are probably going to buy back shorts. 64, another bear bar, smaller body, more overlap, increases the odds of buyers not far below. And then 65, bears gave up, bulls started buying. Strong enough bull bar, probably going to go at least a little bit higher and test the 59 high. However, just like the bears were disappointed who sold the close at 52 after because of the rally, guess what the bulls are thinking who bought the close of 57? They're disappointed and they scaled in lower. Chances are those traders are going to look to get out around the original entry. Some traders will stay long, taking a chance. We plunge, we just rally really quickly to the upside. And if we start to rally and stall, a lot of those traders will get out. And that's why this bar was on a bull bar closing on its high for at least a minute. And then it started to find profit taking. And more bears started selling, more and more bulls started selling out of longs. And then it closed like this bar. Sorry, just one moment. So 66, breakout pullback buy, excuse me, breakout pullback sell, tight trading range, probably buyers below and more sideways. And then you can see we just went sideways into the close. And that's to be expected. Most major trend reversals are really minor. So we had a sell off, start of a channel, and we channeled down for 3 legs. And then we tried to break below, but then it really just became a bear breakout below the channel that evolved into a trading range. On the daily chart, one thing to mention and note, it's important there's a tail below this bar. And that's a warning that traders do not sell into the close, and it's hesitation. And if traders didn't sell into the close, that increases the probability of disappointment tomorrow. So I'm going to talk about always in, and I'll talk about limit orders, and then buy the close, sell the close, and I'll answer questions. Always in short. I thought it was always in short on the close of 3. Why not 2, even though 2 is consecutive bear bars with 1 closing below the midpoint? You could take that trade. My concern was you're right at yesterday's low, and that could be support. So I'd rather wait for one more bar. Always in short on 3, stop somewhere up here for betting on a second leg down. At some point, those bears have to exit, and bulls start buying. If they do, where do the bulls get out? I'd get out below 17. And then as far as buying up here, I don't want to buy up here. The market's already proven to me we're in a channel or a trading range, and buying high in a channel or a trading range is not really that great. And then always if you did hold, you get out. I think you definitely get out below 25 or somewhere up here. When you're swing trading in a trading range, it's not as effective as scalping. So you're buying here and you take your profits, or you hold betting on a small second leg and then you sell above either 15 or 14. You buy, maybe you buy the doji 18, betting that this rally up to 16 is strong enough for a second leg. and then you scalp out near the highs. So the problem with swing trading, I talk about always in because traders need to understand how to trade stop entries, but you also have to realize that trading ranges are not the most effective for stop entries. So then, if trading ranges are not that effective for stop entries, why should one trade stop entries in the first place? You want to trade stop entries for the simple reason that you need to understand stop entries and how swing trading works. Because if you want to trade with limit orders and understand limit order trading, you have to understand stop entries. I saw a couple of messages about asking for either advice on limit order trade management for scalps and limit orders, and really trade management for when to find, where a limit order is talked about in the course. What you have to realize about limit orders is a strong, everything's an opposite. So a strong trend, think about what a stop entry means. A stop entry is a strong breakout, or buying above a bar is betting on a breakout. If you buy above the bar, you're hoping for a bull breakout. If you sell below a bar, you're hoping for a bear breakout. A bad stop entry will always be a good limit order trade. A strong stop entry will always be a terrible limit order trade. So buying below one is really not ideal because it's a reasonable sell taking a chance we break below 41. That means it's a decent stop entry and a bad limit order entry. Buying above bar 5 is a bad stop entry. That means it's a great limit order sell. You sell above the bar. If you are buying above 21, that's a low probability stop entry, 2 or 3 legs up, tight trading range, support or resistance not far above. It's a trading range day. It's a bad stop entry, which means it's probably a better limit order entry. There's always an opposite to everything. Anyways, at some point, bears sell in here. And then what do? Some might get out a couple of points above 34. I think that's okay. And then maybe they sell again below this bar, 38. And they probably get out. They get out here. Some might. Others will hold, betting on a second leg. I think either's fine. If I didn't get out here, you get out above this bar. But if you did get out above 42 or a couple of points above 42, I think it's really hard to sell below 43. It's 3 pushes down, and we could easily get 2 legs up. 45, 44, reasonable swing buy. So always in bulls can buy, but then the market starts to go sideways. I think they just get out, break even, or as this bar starts to reverse down. Always in bears, do they sell? Some might, but again, you're in a channel and you're breaking below the channel, and that will increase the probability that the market does not go much lower. And at some point, if always in bears that are short, they get out above any bull bar or a couple of points above any bull bar. And then always in long here, strong enough for a second leg, but then this becomes a mess. If you buy here and then you see 57 outside bar, outside bars are trading range bars. So then you see this and then this. I think you just start exiting the trade. Exit a couple of points below 59, and then look to buy lower. As far as selling, I would not. I think too much risk of a higher low in a second leg. So always in traders, where do they buy? They might buy above this bar, but it's forcing you to buy in the middle of the range after a tight bear channel. So it could be a lower high that leads to a deep pullback. And then you get 66. Some of the bulls who bought here, when they see 66, they'll just get out break even. And that's why 67 looks the way it does. And then I would just really let this be. There's not any great swing trades or always in trades through here. It's a limit order market. Therefore, it's better to trade with limit orders. For limit orders, I thought it was reasonable to sell above bar 5. You could buy the low of the day or a couple of points below the low of the day. And you could buy below these bars. Traders will probably look to sell around the two low, betting the breakout point closes. Traders will probably try and buy below 15, not get filled. I think they can sell above 15, above 14. They can sell above any of these highs, and they can really sell anywhere up here. And what about buying below 21, scaling in lower? Some traders will, but in a trading range, You always want to be aware of breakout points because breakout points close. And if we have open gaps here, the low of 15, high of 12, or high of 11, chances are those gaps are going to get filled. It's kind of like buying above 21 right here. It's not a great buy. There's an open gap, 18 high, 21 low. And chances are this is probably a trap, trapping bulls into buying high and then reversing down and closing the gap. And then probably, maybe buyers below 24 or even 26 for a scalp, probably sellers above 27, and even buyers below 28. But then you see this bar right here. Because it's a low one short, you have to be thinking about the possibility of a breakout below a bear flag. So if you get the follow through on 29, even though it's weak follow through, a lot of traders will be quick to get out at their original entry, the 28 low. And that's why 30 closed on its low. And then as far as selling above, I would not. It's low in the range. I think if anything, you're buying down here. Bulls buying below 36 for a brief second leg. And some bulls will buy down here. Others will wait. If they did buy, they buy more lower, get out break even. Some traders will sell above, betting on tight bear channel, second leg down likely. And then here, I think it's pretty tough. Tight trading range. We get a downside breakout and probably buyers below 56 or 55 for a second leg up. And then limit orders through here, depending on how aggressive you really want to be. Buy the close, sell the close. I thought I'd sell the close on 3, probably buy the close 14 for a second leg up, sell the close anywhere in here for a scalp, and then maybe sell the close 48, 49, but I think it's pretty tough. And that's probably it for buy the close, sell the close. Question: are there any instances where it's reasonable to enter for a swing trade setting up using limit orders? Are limit orders primarily best for scalping? Yeah, most swing trades are always going to have a decent stop entry. And one way people get into trouble is they they buy the low of a bar like 9 during 33, and they think to themselves, here's their logic. They say, okay, I'm going to buy the low of 12 right here. And I'm going to put a stop all the way down here. So their stops all the way down here. And it's very far, so it's protected. They buy here. And what they don't realize is the first reversal up is probably going to be minor. And if they buy here, they clearly make a profit. I mean, you could easily, your actual risk was 24 to 22, so 2 points. And the market went all the way up to 30, almost 32. So you obviously you made more than your risk. But if you held on to the trade, all of a sudden you start to get this. So for me, and I think a lot of traders, if you're trading for a swing, you need to wait for the swing setup, which means wait for a stop entry. The swing setup on the daily chart is not buying below 6 and just holding for a rally up to here. You will have some traders doing that, but that is more institutional or investors. Bulls buying this low and they hold for several legs, scaling in lower, betting on a retest. That's fine. But the reality is, look down here. Big bear bar follow through. You could have waited for more buying pressure. Even if you didn't buy here and you waited for a brief second leg, you still got a second entry buy. And you got a parabolic wedge. 1, 2, 3. So what do you think is going to happen down here? Obviously, we tested the breakout point, October the 6th. Bulls bought this low, scaled in, made money. But if we're going to reverse up all the way up here, do you think there's going to be time to enter the trade? Of course there is. So a lot of moves that go far, they have a way to enter. You can buy above a bar if it's a bull bar. Look right here. Decent bull bar to buy 42. If you don't, maybe you buy 46. If you don't, you could even buy 59 or 60 and you still had plenty of time left in the move. If you didn't sell anywhere in here and you waited for the pullback and then you saw 33 trying to break out of the range, you could have entered there. Okay, question. I sold below 20 today, hoping we would break out to the downside of the 18 bar range. So they sold below 20 right here. They sold below 20 here, taking a chance they would break out. We would break out below the 18 bar range. So they're taking a chance. They sold here, taking a chance we break out below 12. Was this an okay trade or was the bull channel too tight? Does it make sense to hold after the bad follow through? I think what you did was sensible. And some traders they'll sell the close or they'll sell below, use a wide stop because they want to give the market time and they don't want to miss the trade. Other traders, they'll wait for a bear breakout. To me, I thought at least 60% chance we'd probably test back to this bar right here. Why is that? Because it was a reasonable sell to close bar or a stop entry sell. It's not great, but it's reasonable. It's a big bear bar closing on its low. So a bear who sells below 17 and then sells more higher, like below this bar 20 or just at the high of bar 16 right here, you know the chances are there's probably a 60% chance or more that the bears will able to avoid. The bears will be able to get out at their original entry. That's a trading range market. Trading ranges are really forgiving. Traders sell all the way down here, they scale in all the way up, and then they take their profits down here. And that's what makes it really difficult in here is the market goes sideways. It always makes you question what your premise is. But overall, I think what you did is okay. I think it's important that you recognized it's a tight bull channel, and that would lower the probability. A lot of traders, when they see a channel this tight, they realize that bar 20 is also it's 10-10. So let's just go to it. Let's see what a 10-minute chart looks like. And you can see 10-minute chart is right here. So still a relatively tight bull channel, but the sell-off still appears stronger. Question, can you enter as soon as the market has an always in direction like the close of 2 or bar 30? Can you enter on the close of 2? You can, but for the reasons I mentioned earlier, I think it's better to sell the close of 3. The problem with 2, it's consecutive bear bars, one closing below their midpoint. It's an okay sell. But my problem with that is, in general, it's really better to wait and look to sell closer to sell after you see the breakout. Or is it okay to sell the bar 30 based on always in short? I thought that was reasonable. You sell 30, you take a chance that the market breaks far to the downside. And in this case, it doesn't. It goes sideways. So you're disappointed and you give up. I have a hard time assessing probability. Yeah, that's really common. And that takes just a long time. That's why I tell everybody most traders will be better off if they can focus on one or two things. Have a really good understanding of trading the open, have a really good understanding of something. For me, I like the concept of trading the open because it's measurable. It's the first 2 hours of the day, most days. And also, that does not mean trading bar 1. That means taking all of Al's information and understanding, okay, if we get a trend from the open right here, chances are it's going to be an opening reversal and form a trading range. Why? Because that's what happens more frequently than trend from the opens. If I can deduct that reasoning and form some reasonable expectation of the day, I've got a lot better shot at making money. So that's all the time I have for today. But if I didn't answer your question, save it, ask me it next time, and I'll try and get to it. But anyways, as far as tomorrow goes, it'll be interesting to see. I think tomorrow's going to have a bad follow through and will probably form a bull bar or a disappointment bar. And we probably will not get another strong bear bar. It's possible, but I don't think we will. We're so close to the midpoint of the rally that began in 2022. The midpoint's this red line. I think we'll probably have to get down to it. All right. Thanks everybody for watching, and I will talk to you very soon.